If you can afford to get car insurance, I mean, with life insurance, we should not be having this kind of debate. You need life insurance, and
That's right.
especially if you have dependents.
One of the sureties in life is death, and as long as the Lord tarries, all men shall surely taste death. Yet it's one of the most uncomfortable conversations for many people, and statistics show that in a given classroom, about 2 people will lose their parents before the age of 18. And the statistics is even worse for people from ethnic minority backgrounds. Here in the UK, we know that the mortality rate for Black people is higher than other ethnicities. And so it is important that we confront this conversation. Of course, there are things we can do to improve our health, several videos on those. Yet the grief that our family face in the absence of a parent, perhaps, we can't do much about, but we can do something about the financial burden that they would face. And so today it gives me a lot of pleasure to have this conversation around life insurance and life cover. Somebody who is not new on this channel, Connie, you are not new to this channel, and welcome to Diaspora Careers and Investment.
Thanks for having me. And yeah, like you said, I'm Connie Kavma, self-employed mortgage and protection broker. And like you said, when it comes to life insurance, the main reason why people don't take out such policies is because they don't understand this financial instrument.
That's right.
So thanks for having me here. We are going to just share more light on what it means and the importance of having a life
Let's start.
insurance.
What is life insurance and what are the types that are out there?
So to break it down, life insurance is protection for you and your loved ones in the event of death or an injury or terminal illness. It helps mitigate this kind of risk. When we talk about life insurance, there are so many different types. We have life cover, we have family income benefit, there is critical illness, there's also income protection. But our focus today is going to be on life cover.
Okay.
So life cover, there are so many types under life cover, but we're going to talk about the term life insurance, then the decreasing, and there is the whole of life. Term life cover has a fixed period of time that you're protected. It could be 40 years, it could be 50 years, depending.
So I want us
on
to
the
recap a
policy.
bit. So
Yeah.
for life insurance, we have we can have the life cover, critical illness, family income protection. These do different things. Critical illness,
Yes.
obviously, is when you get critically ill, which is
Yes.
defined differently by different providers. And then the family income protection pays, regular amount to your family, in the event that, there's death or a sickness. And then
Yeah.
there is a life cover, which is in the event of death.
Yes. In the event of death, your family gets a payout.
You can have the level term, decreasing term, and then the whole of life.
Whole of life, yes.
All right. So what are the differences, and then which one do we go for?
So decreasing term, normally they associate this with a loan or a mortgage. So the premiums stay the same, but the sum assured decreases. So
Okay.
with time, the fact that you're paying off your mortgage every month or every year, the sum assured decreases. So this one, in the event of death or critical illness, the outstanding balance on your loan or mortgage is paid off. So
Okay.
that's the decreasing term.
Okay.
Then the level term, it's also for a fixed period of time, but the premiums stay the same and the sum assured or the amount to be paid out stays the same. It's fixed, it does not change. And then the whole of life, it's for the rest of your life. So whenever death happens, your family gets a lump sum, a payout, anytime you die. Unlike level term or decreasing term, there is a fixed period of time. So for example, if you took it out for 40 years and if you don't die within those 40 years, then there is no payout. That's for that term.
Okay.
Then whole of life, it's anytime death happens, your beneficiaries get a payout.
I guess it would also influence how much you pay as as the premium, because if the decreasing term is linked to a given loan, for example, a mortgage, so you take out a mortgage for say 300,000 for 35 years, you died 20 years down the line, that means that your family gets they pay out, the outstanding mortgage money that you've not paid. They pay that allowance to your family, isn't it?
They pay that to clear the mortgage. It's
To
mainly
clear
for
the
the mortgage.
mortgage. Yeah,
Yes, the
because it's
outstanding balance
linked.
on your mortgage
Yeah,
is paid off.
it's paid
Yes,
off. So that
that's
is
what
the
the difference.
decreasing term. And it's not just
Yes,
a mortgage, but any substantial loan that you may have, which
it has to be a secured loan. It's
a
not
secured
any
loan.
type. It's not any
Okay.
type of loan. Yes,
Okay, fair
yes.
enough. And then the
Mm,
level term,
mm.
you pay a given premium for a set time. So you can do it for, I mean, I guess, there may be a limit, that, the lenders, or the brokers would allow you to fix it for, say, till you are 80 or 75. Is there something like that?
Yes, that's the level term.
The
It's
level
fixed for
term.
a certain period of time, and the premium and the payout are fixed.
Are fixed. I guess the
So if
disadvantage there is that
mm,
if you are, if the Lord is kind to you and you live to 81 or 85, that means that your family don't get the payout because the policy would have ended and then you were fortunate not to die within the period, isn't it?
So that could be one of the issues. But the thing is, once you're coming close to the end of the term, you could
Mm,
review it. Some lenders would allow you to do that, or
okay.
else you lose out. It's pretty much, when I'm explaining this, I tell people it's just like car insurance.
Okay.
If you take out your car insurance for 1 year, if nothing happens between that 1 year, you don't get any refunds. You know,
Fair enough.
do
Fair
you know
enough.
that kind of thing? It's not something you're going to carry forward or whatever. But yeah, but then you also have an option to review. You could
Okay.
stay with the same lender or you could change the lender, but you don't
Right.
get any payout.
Okay. And then the whole of life is in perpetuity. So whenever
Yes.
you die, isn't it?
Whenever, yeah.
Then I guess
Whenever
the
you,
price would also differ, because if there's one tied for 25 years or 35 years, and then one is,
mm,
till whenever you die, the price, there must be a price difference, isn't it?
of course, with the whole of life, the premiums are really high as compared
Mm.
to the term. And with the whole of life, there is an aspect that could be considered as an investment, unlike these other ones.
What are we looking at here? Let's take an average person, 30
Mm.
years, they want a life insurance that is going to cover them till maybe they are 80. How much should I be looking at paying if I'm going for the level term compared to the whole of life? What is the price difference? Because at the end of the day, it comes to how much can I afford per month, you see?
Yeah, just to put a disclaimer, I don't think I'll be doing justice to give you exact amount, but I
Yeah.
can give you an example. Let's say with the level term, if the quotation
Yes.
comes out and you're paying 50, if it's whole of life, you could be paying 120 or
Okay.
£100 per month, the
I mean,
premium.
that's not insignificant. That's quite a bit of difference, isn't it?
It's a bit of difference because of the benefits you're getting with
Of
whole of
course.
life are more than the
Of
ones you're
course.
getting with term insurance. So
Mm.
yes, the premiums are significantly higher and different. And it also comes down to, do you know, when they're doing the quotations, there's a lot more they take into consideration when they're
Of
deciding on
course.
how much you're going to pay.
What influences, why would somebody pay, £50 per month for a level term and then someone may be paying, I don't know, 60 or, I mean, it's a bit intuitive, but I wanted to highlight it.
So the things they take into consideration, number one is your age.
Mm.
When you're younger, the premiums are cheaper than when you're older.
But you
The
pay
other
for longer,
thing
of course.
Exactly. The other thing is the underlying conditions,
Right.
things like depression,
Mm.
anxiety, stress. If you've been on any kind of medication, if
Mm.
it's registered somewhere else that you've been on medication for such, those are considered to be underlying conditions. So your
Mm.
premium is going to be higher because the
Mm.
risk is higher.
Mm.
Things like diabetes, then if you are a smoker, the
Mm.
premiums are higher.
Okay.
Then also your weight plays a big part
Mm.
because it could pose some health issues.
Mm.
Someone weighing, let's say, 120 kgs, the premium is going to be higher than someone
Higher.
who weighs 60 kgs. So those are some of the things they take into account when deciding how
I
much you're
guess
going to be paying.
Yeah, I mean, I guess insurance is a measure of risk, isn't it? So that if you are deemed a risky person as far as mortality is concerned, then the
Mm,
premium may be slightly higher than somebody who is deemed, less, risky. What happens if I decide down the line that, you know what, I'm no longer interested in this, I've paid for the last 20 years,
mm.
I'm good. what happens to all my contributions?
It's the same thing I would ask you. If you've been paying car insurance and within 4 months down the road, you're like, I'm not doing this, are they going to give you back the money?
No.
Yeah.
How much are we looking at here? So how much can I, fix it for that, in my demise, how much they should pay my family? What are we looking at? Is it like 200,000, 250,000 pounds? Or what are we looking at? And how do I even decide how much they should pay? Because I'm guessing that how much, I ask them to pay out my family in my demise would also influence, the premium that I pay per month, isn't it?
Exactly. How much you want the payout to be would determine. But
Mm,
also, one other thing you need to know is some companies have a cap.
okay.
When they're doing the valuation, they could say that the maximum payout could be this for you.
Okay.
But having said that, how do you determine how much? It
Yeah.
comes down to the question of what do you want to see happen in the
Mm,
event when you're no
mm,
longer here? What do you
mm,
want to see happen to your loved ones you're leaving
mm.
behind? It
I
could be
want
your
them taken
it could
care
be your
of.
partner, exactly, your partner, your
Yeah.
children. So your
Mm,
children, it could be making sure their college or tuition fees are paid.
of course.
They live a certain lifestyle until maybe the age of 21 or 18.
Okay. Mm,
And maybe the mortgage or whatever is paid off. These are some
mm,
of the things we take into account when you're deciding the amount you want to be assured for you. Then the other things, it comes down to affordability as well. How
mm,
much can you afford? Because
mm.
yes, you could have this dream that I want my family to be looked after in this type of way, but the point is at the moment you can't afford. So we bring
Excellent.
it down to such things. What's most important?
But let's talk about tax implications. There must
Hmm.
be, in this United Kingdom, I'm guessing that there will be tax implications if you were to, in the event that your partner died and then you are taking on an amount of £250,000. I would like to think that there will be tax implications. How can we mitigate that also?
So when it comes to policies, I advise people to put them in trusts. A
Mm,
trust is free and
mm,
it's pretty much straightforward. So
mm,
all you need to do is call your provider, and they will send you the forms. It's called the discretionary trust.
mm,
With this, it will help you mitigate what we call the inheritance tax thing.
mm,
So with inheritance tax, the threshold for each
mm.
individual is 325,000. And we are talking about as an estate, not just your insurance. So
Yes.
an estate is normally all your possessions, the property and the money. It could be savings, it could be your pensions everywhere.
Mm,
So for the taxman to come after you, you need to be
mm.
over the threshold. So
Okay.
yes, I do advise people. For example, if you take out insurance with such large sums of money, put it under a trust.
Mm,
Not only does it help mitigate tax, but also it helps your loved ones to access this payout quicker and
mm,
easier.
mm,
Because say your partner, let's say in the event that your partner is gone and she has not left that trust, she has not left her insurance. We are
in a
talking about
trust.
a separate insurance policies. It's not joint. She has her own, you have your own.
Mm,
In the event that she's dead and the policy is not in a trust, it has to go under probate. Probably right now, the average time we are talking about 7 months. So
well,
if the money she's leaving behind, part of it was to take care of her funeral arrangements, you see
yeah.
that you won't
Yeah.
be able to have the money you need at the right
Yeah.
time.
Yeah.
So the trust, that's one thing I advise people. You have a policy, it's not a joint policy, it's a single policy, just put it in a trust.
Yeah. I
Yeah.
think that is something that I'm not sure we did, and I would pick it up with you afterwards so that we see how we can put our life insurance policies in a trust to make the payment quicker, as well as shield against inheritance tax, because that is what 40% at the moment, isn't
It's 40%. Yeah,
it?
40%. And the thing is, you
uh,
can't access anything unless you've paid off the inheritance tax.
wow.
Would advise people to review their policies on a
Mm,
regular basis.
mm,
It could be annual, but most especially when they are life-changing events that have happened. I'm talking
Mm.
about changes in your marital status,
Okay.
changes in, let's say, in your family. Maybe you have children, maybe before you didn't. Try to review your policies, because maybe
Mm.
the sum assured then might not be enough now.
Okay.
Then things like, if there is a massive change in your weight, this could work in your favor. When you
Okay.
took out the policy, maybe you weighed over 100 pounds, now you're 60. This could
Mm.
help reduce your premium. If
Mm.
you took out your policy when you are a smoker 2 years back or a year back, now you don't smoke, try to review the policy, because this would work in your favor.
That's
Yeah.
right. So I guess, I mean, once the risk reduces, it also reduces the premium that you pay per month. What are some of the things that could inhibit someone from, their family from getting the payout after the demise of their loved one?
All I can put it down is misinformation to when you made the application.
Mm.
Normally, issues are with the application form. If you give false information,
Mm.
number one, like I said, if you were a smoker when you took out the policy and you didn't declare this,
Mm.
and when they are looking at the records, they're actually seeing that by the time you took out the policy, you were a smoker and you didn't declare
Mm.
it. That could be one of the reasons.
What happens? Say I went with company A, and then at the time when 40 years down the line they go bust. Is there any protection for our life insurance payments? Is there any government protections against these?
The Financial Conduct Authority has something in place to protect consumers when it comes to this. It's the same thing with the banks. You could
Okay.
be banking with a certain bank, and once it goes bust, there is a certain amount of your money that you could recover. One thing I wanted to mention is, with policies, do you see the premium you pay every month? One
Mhm.
thing that could lead to not getting a payout is if you miss your premium, paying your
Okay.
premium. Within, some of them give you 30 days, some of them could give you more. But when you're taking out a policy, what I ask people is, if you have the benefit of getting what they call the waiver of premium. Waiver
Mm.
of premium is in certain circumstances where you're out of work and you're not able to pay the premium, they could give you 6 months
Okay.
whereby you don't pay, but it's not cancelled. Your policy is not cancelled.
Mm.
It's called the waiver of premium. If you add it on your policy, it's a small amount of money. It could be even £1. It could be
Okay.
an extra 25 cents per month.
Okay.
But yeah, there's something they call the waiver of premium. Just be careful about that.
I mean, clearly there's a lot more that goes into this, that it appears that it would be useful to speak to somebody like yourself or a broker who can check the market to see, what, policy provider, suit individual circumstances. I'm sure you share your handles with me so that people can reach out to you, in the event that they wish to review and I'll certainly reach out to you to review their life insurance policies or to even take out a policy to discuss these things. Is that something you'd be happy to help with?
I'll be really, really happy to do that. And one thing I
Right.
wanted to point out is, I get people who come out asking for cheap quotations. And my take on this is, nowadays, cheap is really, really expensive.
That's
Because
right.
just because the quotation is cheap doesn't mean it's going to do what you need to be done. Do you
Mm.
know that kind of thing? You look at different quotations and everyone is like, I want the cheapest. But the question
Mm.
is the cheapest doing what you want it to do?
Mm.
So my advice is, before you take out a policy, right? Make sure it's going to give you what you need. If right now you can't afford what you need, I would rather put it on hold rather than
Okay.
ticking a box that I have life insurance, but in
Mm.
actual sense, it's not going to give you what you need.
I know this conversation can go on, and many people would have several questions. And please do use the comment section to put your questions so that Connie will be in the comment section, responding to these. So let us try to wrap up on this. What happens if I take out this insurance policy and then 20 years down the line, I decide that, I'm relocating to Ghana or say Nigeria or even, the US? What happens with my insurance? Do they pay me a part of my contributions or can I transfer it? How does it work?
The question is, when you're paying your car insurance and you're relocating to these countries, Are you going to call the provider and tell them you need to transfer?
Well, this has been a very useful conversation, and I hope we would have you back so that we talk of the other life insurance policies like critical illness. And I think that's one that I am particularly interested in. One final question, and then I'll take your closing remarks. I know a colleague who, is struggling to get life insurance because they've got an underlying condition. Where can they go to get one? In fact, they are being termed that they are not insurable, which is a very depressing term, I must say. What is your advice regarding such a person?
All I can say is you can ask them to contact me because, of course, we have high street providers and we have the specialist ones.
Okay.
So the specialist lenders would look at such complex cases. The only thing one needs to know with complex cases means the premiums are higher.
Of course.
But yeah, we should be able to get something for them.
This has been a very useful conversation. I'll let you give some closing remarks and we can have another conversation later.
So my closing remarks when it comes to life insurance would be, think of what would happen to your loved ones in the event that you're not here, especially if you are a breadwinner. Have you put anything aside to make sure that your children maintain a lifestyle they're leading right now? They are not kicked out of the house and they attain a certain level of education. And if the answer is no, the question is, what do you plan to do about it? We might think we have time, but I think the last 6 years with COVID and all that, they've showed us that anything could happen at any time.
Well, thanks very much, Connie. And I mean, this is like what, a third time we having you here, and you're always very helpful. I'm really grateful, and God bless, and see you again soon.
Thanks for that. All right. Thanks for having me.